Welcome to this special White Coat Investor webinar. I'm here with CEO of DLP Capital, Don Wenner, a good friend of mine. We were recently together down in Arizona at the White Coat Investor Conference, the Physician Wellness and Financial Literacy Conference. It was great to see you down there, Don.
It was an awesome conference to get to spend with you and about 600 of our friends. So what a great time.
Yeah, it was good times. You put on a very nice dinner that first night, and I know a lot of people enjoyed that and enjoyed learning more about DLP, which is what we're doing today. Is we're going to be talking about DLP and what's going on in commercial real estate and what opportunities are available there for white coat investors. And I think we'll start with you giving a presentation about DLP for those who don't know much about the company, as well as what's new and different with DLP this year. And then we're going to do some questions at the end. So I'm going to turn the time over to you and let you present for a bit.
Well, thank you for that, Jim. And that sounds wonderful. So yes, for those who are new to us, I'll give a kind of brief overview to us as an organization. I'll walk through how we invest. And even for those who've been with us a while, I'll give an update to what are the incentives we have going on today? What are the funds that are open today? How some of the crazy things going on in the market are affecting what we're doing here today and moving forward, and then certainly turn time for questions. So with that said, I'll jump right in. This is I like to say, my Barry slide, who's our chief legal counsel, but this is not a solicitation. But a little overview on DLP. We're a financial services and real estate investment company focused on making an impact on a few really big crises, including the most obvious one for what we do, which is the affordable workforce housing crisis, which I'll be touching on here in my presentation. That picture on the slide is actually where I'm talking to you right now. That's our headquarters here in St. Augustine, Florida. This picture here is an overview of my family. This was in New Orleans last week, where a number of white coat investors joined us. This is at the World War II Museum in New Orleans, which is pretty amazing if you've never been there. But that's my wife, Carla, our three boys, Donnie, Alex, and the baby, Jake, in my arms. I started DLP 17 years ago. Since then, we've done over 30,000 real estate transactions. We've invested over $10 billion over the time. About half of that has been as a sponsor, an equity investor, operator, developer, and about half as a lender. And those are the two sides of what we do that we're going to talk about here in the next few minutes. Live here in St. Augustine, Florida, as mentioned a moment ago, and also have a home in Asheville, North Carolina. What we do at DLP is we invest in and finance the building of thriving communities that transform lives. It's a big statement, I know. And some of the ways that we do that are we develop and construct new affordable workforce housing communities. We have a fund focused on doing just that. We acquire and manage existing affordable workforce housing communities. We have a fund focus on doing just that. And then we have two funds that lend money to other developers, operators who acquire and build housing that's affordable for local families. So do things very similar to what we do on the ownership side. Our purpose at DLP, which stands for Dream, Live, Prosper, that's what DLP stands for. Dream, Live, Prosper, passionately making extraordinary impact by transforming lives and building thriving communities. Our big, hairy, audacious goal is to provide housing to 1 million people. Right now, as you'll see in one of the next slides, today we're providing housing to about 85,000 people. So we have some work to do yet. And once we hit that target, we believe we'll be one of the Forbes 100 largest private companies in America. So pretty excited for that big goal. And our mission is to become the largest investor in rental housing in America. Actually, first in America, and then the real big mission is in the entire world. This is how we're going to do that. This is our flywheel at DLP. This is our business model, kind of, you could say, in one slide. Everything starts with capital being invested into our private funds by investors, by many white coat investors today. We're very proud. Realized coming into your event a few weeks ago, we had over 400 white coat investors already invested with us out of the 2,300 families that invest with DLP today. And then we invest in housing. So I mentioned some of the ways we do that in the past slide as a lender, as a developer, as an operator. But what we do is we invest in housing. Our secret sauce, per se, is we build elite organizations. We build really disciplined organizations that are able to maintain consistent growth year over year over year. We've done that at DLP, being one of the 5,000 fastest growing companies in America now for 10 straight years. We've grown our revenue by more than 50% every year for 17 straight years. And we're helping other real estate developers, operators do the same. Those are the people we lend to and partner with. And then the last part to our business model is we create prosperity for our stakeholders. Those are the investors investing with us, the sponsors we're lending to and partnering with, the residents who live in our properties, and the team members who choose to work at DLP. We do that through our utilizing these 10 core values. Hopefully, as you get to know myself and the leaders here at DLP, Rich and Larry, and the members of our investor relations team, you'll see these values exuding from us. One of the big ones in the center of the screen there is stewardship, a value and a responsibility we take very seriously, and being responsible for a percentage of our investors' wealth, percentage of their hard-earned assets. Some of the recent success at DLP, as Jim mentioned, we were very honored to host a dinner event at the onset of the White Coat event, and get to engage with many of the attendees over the course of the few days in Arizona. Then last week, here's some pictures of our event we were just at in New Orleans. Top right is Andre Reed, Hall of Fame wide receiver. Got to have a chance to have a legacy conversation with him. Really cool event. Had about 300 of our the families that invest with us a part of this event with us. These are some of the recent awards that we've won. Our awards that we win revolve around three types of things that we win awards for. One, for building a great place to work. Two, for the growth that we consistently have. And three, for making an impact. And one of the biggest awards we've received of recent is the Real Leaders Impact Awards. We're one of the 300 organizations recognized throughout the world for making a positive impact, which was a pretty cool honor. Another big success, it feels like it's been a while now, but it was just a few months ago, we acquired a bank called Community State Bank here in Florida. And one of the reasons I highlight this, and the investors in this bank are some of the same investors who invest in our funds. We went out to our investors in our funds and gave them the opportunity to invest. And we have about 80 of our investors a part of this bank with us. But the other interesting thing about this is you may have heard, obviously, there's a lot of kind of craziness going on in the world of banking today. And in some of the past cycles, some of the most common banking issues came about from, real estate developers owning banks, right? It hasn't been the greatest track record in banking history. So I say that in that regulators are keen to that. And they did a significant, heavy amount of due diligence on myself, as I'm what's called the control shareholder of the bank, the entire leadership team, all of DLP's financials, to approve us to acquire a federally regulated bank, and receive that approval last year. So pretty excited about this and the services we're going to be able to offer out to all of our members of our community through this bank in the coming months and years. This is DLP by size today. Almost 2,300 investors invested with us. We have $4 billion in assets, providing housing to 85,000 plus people today, as I mentioned. We've invested over $2 billion this past year alone, as a lender and as an owner. As I mentioned a moment ago, now over 450 members of White Coat invested with us, which is amazing. And if anybody is in this listening to this webinar who happens to live in Vermont or knows anyone in Vermont, please put them in touch with us. We realized the other day that was the only state that we don't have any investors in Vermont somehow. So we do need to change that here. We'll be extra motivated to have you join us if you're in Vermont. This is where we're located. Top left is where I am right now. We also have headquarters in Pennsylvania, where I started the company, Allentown, Pennsylvania, 17 years ago, and then Orlando, Florida, and Asheville, North Carolina. This is our leadership team across DLP. On the bottom, I guess you call it left and right, are Rich and Larry, who are heavily involved throughout the White Coat community. And as mentioned, we're focused on making a positive impact and building thriving communities. One of the big ways we focus on doing that is the workforce affordable housing crisis. Right now, today, over a quarter of renters are spending over half of their income on rent. About half of Americans are spending more than 30% of their gross income on their rent. it's generally thought to be that if your rent is more than 30% of your gross income, that you're ending up having to sacrifice some of the basics of healthcare, of food, of childcare, of basic needs, when your rent ends up being, again, more than 30% of your total gross income. And that's what we focus on doing, is providing housing that is and remain affordable for the local workforce. And our housing today, on average, is 18 to 20% of the incomes within the areas where our properties are located, keeping those properties affordable for families who live there or who work there to be able to live in our communities. And that's how we underwrite. We self-mandate and require ourselves to do that, have housing that is and remain affordable for the local workforce. Here's some of our numbers and how we go about making an impact, some of the ways that we measure it. We last year had over $40 million of rent collected from residents who are living in housing that is and will remain affordable. We have over 2,200 families invested with us, or 85,000 residents living in our properties. Over 800 people are part of what we call our Prosperity membership, which is a membership community we built, which is at no cost to our investors, where we help families avoid what we call the shirt sleeves to shirt sleeves in 3 generations. The fact that so many first generation wealth creators have that wealth not only lost by second or third generation, have that wealth actually be more of a liability than an asset for future generations. We help provide a lot of education and training and connections and relationships to avoid that, like the event we did last week centered around legacy. These are the 4 crises, 4 of the big crises we focus on as a whole around building thriving communities. Touched on the affordability of housing crisis, and we call the wealth legacy crisis, which is the crisis that wealth is lost by second or third generation and does more harm than good in many cases. We're also focused on job creation, the American workforce crisis, and we call the happiness crisis, which we could spend the entire rest of our time talking about. It's a big topic. A lot of people today call it the loneliness crisis, but the unhappiness, levels of depression, a lot of the problems going on, not only in all Americans, but maybe scariest of all with, teenagers and children in today's in throughout America today. So we make an impact on those crises I just showed, and a number of ways in building thriving communities, while at the same time not making an impact be in conflict with doing what you'd expect from us as an investment manager. Hitting and achieving the targeted returns we set across our funds, generating consistent distribution, providing liquidity, having an investment structure that we think is very friendly to investors, and having the benefits of being a private investment manager, which I'll highlight what I mean by that in a minute. So in terms of hitting targeted returns, we've now been managing funds for investors now for well over a decade. We've had 0 months of missing any target returns. We've had 0 losses to any investor ever in any fund. And we've generated double-digit returns in every fund since we started. We take that, to us, this slide is a really, really big deal. And we think to many of the families who invest with us, is a significant big deal. And we've done this through now multiple cycles and significant volatility. This is some of the performance we had in 2022, this past year. We deployed capital as a lender, over $825 million of loans, as a owner, buying nearly $1 billion of real estate, and we generated double-digit returns across all of our equity funds. These are our returns since inception across all of our funds that are open today. Double-digit returns across all of our equity funds. Not only are we generating double-digit returns, we're paying out distributions monthly in all of our funds except the Building Communities Fund, which pays out distributions quarterly. We do all of this while providing no lockout period. So when you invest with us, your money's not tied up for a year or 3 years or 5 years. All of our funds are evergreen, meaning we expect to run the funds for many, many years, but you have liquidity that you can exit with 90-day notice or each year, depending on the fund, while producing, again, monthly or quarterly preferred returns. In all of our funds, our investors are paid first. They get paid even before we earn a management fee. So investors get all the money first. And then we actually incentivize investors to as they grow their accounts with us, we reduce the fees we earn after you get your preferred return. And as Jim mentioned, we now have maybe he didn't mention actually, we have now lowered, I'll mention it, our minimum investment for white co-investors to $100,000, which I'll highlight again in a moment. And we do this with no commissions being paid. So we don't pay out any commissions when you invest in public REITs or even some other private investment vehicles out there, significant money gets paid out in commissions, which ultimately comes from the returns. We have the benefits of significantly lower regulatory and compliance costs. We have more flexibility in being a private fund manager and great alignment of interest. I'm our largest investor by far. 60 team members at DLP are invested in our fund, including our entire senior leadership team. We believe even though we're a private fund manager who services individual families who invest with us, we're still providing institutional level quality in our service, the fund structures, us as a manager, us as a company, our audit, third-party valuations, compliance, etc. And we're doing all of this that I'm highlighting here, even in volatile times like today. We've never stopped distributions. We've never missed a targeted return, as mentioned a moment ago. What we're doing in how we're investing is we're building thriving communities that transform lives. That's by investing in workforce housing. That means single-family housing, meaning single-family communities, multifamily communities, mobile home parks, and RV resorts. So these are all different forms of rental communities. We only invest in markets where we have deep expertise. We only invest in markets that we really understand and believe in that market over the duration of our investment. We do so as a lender, as a preferred equity partner to other sponsors, and then directly as a sponsor and operator. Every single investment that's made by our funds, our fund investors have significant equity that's subordinate to the investment made by the fund. This is where we invest heavily in the Southeast. Florida is our number one state. Texas is our number two state. The rest of the Sun Belt region. And then we do have a significant amount of assets in Pennsylvania where we started the company as well. Florida's number one, Texas two, and Pennsylvania's third in terms of where our capital is invested. The reasons we think people should be interested in investing with us, we consistently do what we say we're going to do. We transparently communicate what we're doing, show clear reporting. We meet and exceed expectations. We have significantly skin in the game in what we invest in, and we're world-class at the things we do. We say humbly that allows us to generate outsized performance, especially in volatile times. And the biggest testament that we're doing a good job, to me, is that more than 70% of our investments come from our existing investors adding more money with us. So last year, we had over $470 million of capital invested with us. Over 70% of that came from existing investors investing more money with us. And out of the remaining 30%, over half of that is referrals from our existing investors. So what is available for investors today? Before I show the exact funds, I'll highlight a couple incentives. I mentioned this already once before. For white coat investors only, we've lowered our minimum from $200,000 to $100,000 just in the last few weeks. So $100,000. In addition to the equity returns that I've been talking about, we do have the option to invest as a fixed note holder, where you're actually getting a fixed return on your money. And right now we're offering a 9% fixed return until we bring in 25 million of notes. So this will probably be open for the next 4 to 6 weeks. This is a 3-year note where you get a 9% fixed return over the life of that investment. You can take distributions every month or let it compound and grow. Right now in our building community fund, which is the first fund I'm going to highlight, we guarantee that when you make your investment, that your money will be deployed the same day you invest, meaning you're starting to earn your double-digit returns the same day you send in your capital. So with that said, the funds that are available today, first is the Building Community Fund. This fund does one thing simply. It invests in building new workforce housing communities. It's our only fund that does that. It has the highest return target of any of our funds. It has an 11 to 13% return target, 8% preferred return, which is paid out quarterly. Last year, we generated 13.07 net to investors, again, with a $100,000 minimum, quarterly distributions, and annual liquidity. Then we have the housing fund. This fund does one thing. It invests in existing workforce housing communities. The fund today owns about 17,000 housing units, providing housing to more than 40,000 people, has high targeted returns, monthly distributions, significant tax benefits. To date, the fund has not had any taxable income to any investors invested in the fund. We've generated over a 26% return net to investors since the fund started. The target's 10 to 12 with a 6% preferred return paid out monthly and annual liquidity. Then we move to our lending funds, our longest standing fund. We've been running this fund since 2014. This fund does one thing. It makes first position mortgages backed by commercial real estate, mainly housing communities. We're lending to professional, full-time, experienced real estate operators on average who have $1.5 million liquidity, over a $10 million net worth. And we're making first position mortgages on average around 54-55% loan to value. All of the income gets paid out monthly. We actually pay out 2 distributions a month, 90-day liquidity, and 1099 tax reporting. So you get a 1099 statement at the end of January each year. The fund has nearly a 13% return since we started, has a target of 9 to 10%, 8% preferred return, and 90-day liquidity. All of the income being paid out monthly. So double-digit annual returns paid out monthly with 90-day liquidity, first position mortgages. And then these are our returns, annualized returns month over month over the last 4 or 5 years of the fund. Great, consistent double-digit returns. And then finally, we have the preferred credit fund, which is our other lending fund. This is a fund that does the same thing the lending fund does, but then it also has the ability to do subordinate loans. And generally, people think if it's not first position, it's higher risk. You could argue that to be true. But I would argue that this fund actually takes a lower risk position than even our first position lending fund, in that these are all loans made only to the highest quality sponsors. Every loan to date has been made with over $1 million of equity invested behind the fund. And to give you an idea, knock on wood, I'll say here as I literally knock on wood, we've never had a delinquency in this fund, just to give an idea to the quality of lending we've done. So this fund has a slightly higher targets than the lending fund, 9% preferred returns, our highest preferred return. It gets paid to you before we earn anything. We don't even get a management fee until you get 9% paid out to you monthly, 10 to 11% target with the same 90-day liquidity. And then lastly, we have our note offerings, a fixed return guaranteed by DLP, not guaranteed by the FDIC. You can take a 30-day note where you can redeem at any time, which is 30-day notice, or take advantage of these higher rate 3-year notes that we're offering this incentive on right now at 9%. And then last thing before I turn to you, Jim, for questions, I showed some of the pictures from the event we had in New Orleans just last week. Our next event is our annual event centered around family. Not only an event that typically, our investors and their spouses, significant other come to, but also we invite grown adult children, teenage children, and even school-age children to come join us. We'll have content, great speakers, and education for all the above in terms of age. This event centered around avoiding that shirt sleeves to shirt sleeves in 3 generation, which is really, it sounds harsh to say this, is really a parenting issue. There's not many families enough communication, clear values established, clear understanding of the purpose and the meaning of the wealth. And that's what we focus on making an impact on here. It's a great time as well, a lot of fun. We'll be in Ponte Vedra Beach, which if you don't know where that is, right outside of Jacksonville, about 20 minutes north of me here in St. Augustine at the beautiful Sawgrass. So love for you to come join us here in Ponte Vedra. So with that said, Jim, I'm going to turn to you. And then anybody wants to follow up with myself or our team, you can use this QR code or go to invest at DLP Capital. And of course, all the information is on Whitecoat's website as well. So I'm going to stop my share, Jim, and turn to you for questions.
Awesome. The best link to put in if you're looking for more information right now, whitecoatinvestor.com/DLP. Easy to remember there. That museum in New Orleans is awesome. I've been to that World War II museum. We were there a couple of years ago for our Christmas break, and that was definitely a highlight. It's a very cool museum.
It was very cool. And my team did a great job. They got the whole place closed down just for us. So we got to not only have a great dinner there, but tour around it. It was a really, really cool experience.
Awesome. Well, let's do a few questions here. These are questions I hear frequently about DLP as well as other commercial real estate investors. But let's talk a little more in depth, I think. You've given a great overview, but let's talk about how the world's changed in the last year, since the last time we did one of these webinars. Interest rates have gone up 4%-ish in the last year plus. What does that mean for the debt fund?
Yeah, it's a wonderful question. So on our debt funds, we're in short, we half of our money in the fund is investors' money. The investors coming in, as I described, generating a double-digit return with 90-day liquidity. And then about half of our money comes in from leverage, from mainly regional banks. And so as you just mentioned, the rates that we're paying for the debt we're borrowing have gone up about 4%. As I showed in one of the past slides, our returns to investors have stayed about flat. And that's been, a call by design. So what our focus has been on using this opportunity to find the highest quality sponsors, mainly continue to lend to the highest quality sponsors we already were lending to, be able to increase our rates to them while keeping leverage down, to be able to keep our returns at double digits. So in effect, we've been able to increase our rates by about 2% that we're charging borrowers while only lending to our highest quality borrowers while lowering our leverage 5 to 10%. So we've reduced risk, increased quality of borrower, and kept returns about flat, despite the fact that our cost of leverage on half of our capital has gone up by about 4%. And that's been our focus. We could have taken more risk and lent to lower quality borrowers, lent at higher leverage points, and increased returns. But our focus is on hitting our mandate. And our mandate is to hit over 9% returns net to investors. And we've been able to do that, stay over 10% while mitigating risk. And that's why we've had to date, we've never written off $1 of interest on any loan we've ever written, over 4,000 loans. Haven't written off $1 of principal, and have actually had delinquency decrease over the past year despite the volatility.
What does that mean for them? I mean, is there less demand for loans from the debt fund than there was a year or two ago? Or is there increased demand because you've only increased rates 2% while general interest rates have gone up 4%? How's that affect the operation of the fund?
So realistically today, and I probably couldn't have said this a year ago or 2 years ago, but today, if I had twice the capital, I could write twice as many loans without any decrease in quality today. So the demand has never been higher, and the demand's never been higher for a few reasons. One big one is the borrowers we lend to are bankable borrowers. They can go to banks, they can go to agency, they can get the best financing out there. The reason they borrow from us is a couple of reasons. One is surety of execution, 2 is speed, and 3 is reduction in, I'll call, friction costs. And so, a year ago, they may have been able to go to a traditional bank and borrow at 3.5%, and we were 9.5%. Right? That's a pretty big gap. And some of the best borrowers would say, all right, it's worth dealing with the pain to work with a bank when it was 3.5 and DLP was 9.5. Well, now that bank is 7.5 or 8.5, and DLP is 11.5 or 11, the gap has closed. So they'd rather borrow from us and pay a little bit higher for the short-term nature of our type of lending. That's one reason. But the bigger reason is in this market is most lenders don't have liquidity today. Liquidity is a major challenge. So many lenders right now are struggling because they wrote a lot of loans, locked in low interest rate loans for 5 years, 10 years, 20, 30 years, and are struggling with liquidity that a lot of lenders, both banks as well as other private lenders, don't have access to capital today. So the demand for our capital, has never been higher, as so many of the other sources out there just are out of the market today. So we're in a really, really great position that we can really choose who we want to lend to. We built deep relationships with people who know us and trust us. And we can lend, again, we've lowered our leverage 5-10%, and it hasn't deterred any business away. So we're in a really great position today.
Now, last year, private real estate absolutely smoked publicly traded real estate. It might be the biggest delta of any year since we've been keeping records. I think, the Vanguard REIT fund was down 23 or 25% or something like that on the year, while just about every private real estate investment I had last year had a positive return. What does that mean going forward? Should we expect the pendulum to swing back a little bit, or what do you see in your crystal ball?
That's a great question. It's one that probably could spend a whole lot of time on. But I'll say two things that I would say in relation to that. One is the public market real estate funds, which there's a lot more of real estate that's tied to public markets than I think most people realize. And so a lot of real estate is owned in the public markets, and even more percentage of the debt comes from public markets than I think people realize. And that's why there's such a lack of liquidity that I talked about a moment ago. But so much of the value of your public real estate investment is tied to volatility, not just of the real estate, but even more so to the sentiment or the fear around real estate. And we're seeing it right now today. And in my opinion, some of the strongest, best banks in the country have seen their value of their stocks go down by 50%. Did the actual value of that bank decrease by 50%? Did their cash flow or income drop by 50%? No. And so I think you'll see those swings both in the negative and in the increase of assets trading above tangible book value, or significantly right now today below tangible book value, the actual value of the real estate significantly. So for us, all that matters is the actual tangible value of the real estate, not the perception of it or the fear related to it or the volatility around the direction of it. So I think that's important to note. So there's a lot less volatility in the private markets. But I think the bigger thing to think about, so I love, the Blackstones of the world. I love a lot of, the Fortress and a lot of these great, these big public, private equity firms, or public companies and private equity firms that are sometimes one and the same, really. But these big companies, in that I love to sell properties to them. I love to buy from them when I love to borrow from them. Or sell them loans. So example, some of the groups I mentioned and some I didn't mention, are some of the biggest group that we've sold 30-year mortgages to, that we've originated, that we don't want to keep on our balance sheet because we don't want 4 or 5% loans on our balance sheet. And we were selling them to these guys, right? We've sold assets to them. We'll do all the hard work to get a property performing really well and sell to them at a really incredible price. So I think they're great, and that they have big money to deploy. They have cheap capital to deploy, and so they can be great to borrow from, great to sell from, and sometimes great to buy from. But what they're generally not is great operators. So generally speaking, they don't have the ability to operate and do the heavy lift that operators like us would do. And then in addition, they generally have, as I mentioned before, in the benefits of private funds, significant commissions and regulatory costs and so forth that eat away from the cost. So when a nice property that's fully performing gets put out there with the Cushman Wakefields of the world, these big public groups will pay, generally speaking, 5, 10, 15, 20% higher than a group like DLP can pay. And then they add on top of that layers of additional expenses and compliance and commissions. When you're paying higher prices, and you're having significantly higher, compliance, regulatory, and commission costs, it's not possible, in my opinion, to generate as strong of returns as groups like DLP are able to generate. There's not enough meat there to go around when you're paying higher prices with significantly higher costs. So I think those are some of the factors when you look over time why the public funds are going to generally underperform the best private operators. And I think they can get away from writing down their assets by 20% in a quarter and then showing the next 5 years that it just goes up. Well, they wrote off 20% or 30% in one quarter, right? And marked everything down and said, oops, what can we do? You see that if you look back over history time and time again. My investors would not be okay if I marked down my assets 20% and said, let's just start from scratch here again, right? And let's forget that one quarter. It's a very interesting dichotomy between the private markets and public markets, especially when it comes to, asset classes like multifamily.
Now, some of the private funds out there are not marked to market at all. You really have no idea what your investment is worth for 5, 7, 10 years, whatever, until the fund wraps up and the assets are sold. But you're running evergreen funds and you're providing liquidity at least once a year. So that means you have to actually determine the value of the properties in the fund once a year. Can you talk about when and how you do that?
That's a great question. I'm glad you brought it up, because when you asked the last question about the difference in the public and private markets, one of the reasons sometimes the private markets don't show as volatile is that reason. They're not marking their assets to value. So they're not reflecting the fact that maybe the value of the assets has declined this past year the same way the public markets are. So we think our evergreen structure of the DLP funds creates a really unique and I'll call happy medium between the benefits of the private side and the benefits of the public side, that you have an updated, value of your assets. So we have to go through every property we own. So in our DLP Housing Funds example owns, 17, 18,000 units today across 60 plus different properties. We have to go through every year and get all of those properties revalued. So we have to get a third party appraiser hired from a CBRE, Cushman Wakefield, et cetera, who goes out and does a detailed 100+ page report, physically inspects that property, puts a value on it. Then that value goes to our third-party auditors, Cohen Resnick, who they not only have an audit department that goes through and audits it, but they actually have an appraisal review or valuation review department who does their own valuation of the property and gives their feedback and talks to the appraiser. So we actually go through kind of multiple layers of valuation every single year. And we're actually doing this all year long at DLP. We're going and getting what we call broker opinions of value, BOVs, across our portfolio, and making sure we're staying up to speed to what's going on with the value, looking for opportunities to drive value, getting perspective from the market of how we can best create value. But we have to do that on a regular basis. And there's no doubt about it, in my opinion, from Q1 of 2022 to Q4 of 2022, if you had the same property performing the exact same at the beginning of the year to the end of the year, the value went down. Cap rates went up. That's really across the board. I don't think there's really any argument to that. That doesn't mean, though, at DLP, as an example, our values went up last year across our portfolio, even though the cap rates increased significantly, i.e. values went down significantly, in the 10 to 15% range. That's if we didn't create any value throughout the year. And so all year long, we're executing on a heavy value add plan. We're driving up the operating income. We're driving up our rents. We're cutting expenses. We're improving the value of our assets throughout the year, which allowed us, even in a tough year like last year, where property values softened, to have our net values across our portfolio go up.
Now, so far, the income from the housing fund has been completely covered by depreciation. No taxable income has been distributed. Under what circumstances can or will that change in the future?
It's a great question. I'd say there's a number of things that could happen, right? None of us know what tax law and what tax code is going to be in 4 years or 8 years or 12 years. So could capital gains laws change? There's talk about it every political cycle. Could the rules around depreciation change? It could. Right? There's a lot of things that could happen down the road from tax code standpoint that could make a difference. In addition, if we do even better in this cycle than we did in COVID, and generate really incredible returns, we could hit a certain return level that we can't cover all the income through tax, which is a really good problem to have ultimately. If returns significantly outpaced our ability to cover those earnings through depreciation. So far, and not just in this fund, but all the equity funds we've done over the past 10 plus years, we've been able to cover all of the income through depreciation largely. And there's other benefits to our funds are private REITs. We get a number of unique REIT benefits, including unlimited, what's called QBI, qualified business income. We also have the ability to sell assets within the fund and do 1031 exchanges and fully defer gains. We have a number of, I'll call, levers we can use. And so our expectation is that we'll be able to continue to defer tax for all investors while they're invested in the fund. Can't and don't make any promises or guarantee that will be the case, that tax law won't change. But we think, we'll be able to be in a position in this fund to be as tax friendly, as tax advantageous as virtually anywhere else you can go, certainly compared to any other real estate vehicle, which generally speaking, real estate is one of, if not the most tax friendly, asset class.
Now, while the funds have never lost money, I'm sure some of the properties in the fund have not performed as well as you had hoped. What's been your biggest disaster in that department, and what did you learn from it?
Yeah, and every quarter we produce full reporting on the fund, and we mark every one of our properties. Is it performing to budget? Is it overperforming? Is it underperforming? And I don't think there's been a quarter yet. Maybe the first quarter or two. I'd have to go and look back, but I don't think there's been a quarter or two yet that there hasn't been at least one or two properties that are underperforming. And that's one of the benefits of being in a fund that today, as mentioned before, owns over 60 properties, over 18,000 units, is you can have a couple properties underperforming and still, exceed and investment targets. And that's as we've done, over the last number of years. But there could be a wide variety of reasons that a property underperforms, and sometimes it can underperform on the short term, but still overperform over the life of the investment. I.e., maybe we bought a property and we thought in year one we were going to generate a certain amount of cash flow, and we realized, hey, there was more work that needed to do, or maybe we made the actual decision that we're going to do more renovations than we originally planned because we realized it would generate a better overall investment, but hurt us on the short term. We have that flexibility to kind of adjust within the fund because it's evergreen, and we can adjust based on what's going on in the market, based on what's going on in the asset and its local market. But managing multifamily real estate, despite what a lot of sponsors out there may lead you to believe over the last number of years, it's hard. And you're dealing with, as I mentioned before, we have 40,000 plus people that live in our properties, right? We have thousands of new people moving in every year. We're literally painting and renovating and dealing with plumbing issues every single day, right? Thousands of them a year. We deal with tens of thousands of work orders a year across the assets in the housing fund. We have companies go out of business. We may have an employer who employs a good percentage of our employees that goes out of business and affects that local market. We have things like COVID come about where the government essentially tells residents they don't need to pay their rent, right? And where courts shut down and you can't evict anybody because you can't get through the court system, right? There's a million different volatility, and things that can happen that can affect the performance of an asset, especially in 1 month or 1 quarter over a short period of time. And so you have to work through it. It's every day, challenge. We had a property that had maintained 90+% occupancy for 4 or 5 years, and all of a sudden, we had a really tough quarter. It was a local market issue, a small market, and occupancy plummeted down into the high 70s. And I just got a report yesterday, we're back into the 90s, but it took 4 or 5 months of heavy work and focus and our corporate leadership team being out there and enhanced marketing efforts and really hands-on work. But there's always challenges, and that's why it's so important that we're vertically integrated and we're very, very hands-on and working through the many challenges that come about and dealing with neighbors and roofs and plumbing and people. It's a lot of work.
Let's do one more question as our time's starting to get short now, but I think it's an important one because in investing is far more about risk management than it is about seeking returns. What do you see as the biggest risks that a DLP investor is running?
I think I don't know if this is a DLP investor specific risk, but my strong opinion is there's 2 things that matter in making an investment. One is the strategy you're invested in. Does that strategy make sense for the duration of your investment? I think most people, now understand, accept, and believe that investing in, housing, workforce housing is a really great strategy, not just for the next year, 3 or 5 years, but long term. And so we have that great benefit that we chose a great, asset class. We chose a place to invest. It's a great strategy, at least over the foreseeable future. That's obviously to any investor to make that decision on their own. But there's lots of, fund managers out there, lots of investment managers out there who invest in housing. And the majority are going to have a rough next probably year or two. There's going to be more, I believe there's going to be more, multifamily operators out there who are struggling to make distributions, struggling to hit anywhere close to the targets they set, over the next, again, year or two. And so what I think is most important is strategy that makes sense. And then second is management, investing in the best management. I believe whether it's a real estate investment or any public company out there, the best management teams generally outperform in volatile times and pick up market share. And these types of times is where they generate a lot of the value and create a lot of wealth. And so I believe strongly and humbly that we are, best in class, managers in what we do. But I think that's the decision to make. Is this somebody you're going to trust in good times and in bad times? It's going to be able to make good, sound decisions and be able to, shepherd and steward your investments.
All right. Well, I think we've come to the end of another great webinar. If you're looking for more information about the 4 funds available from DLP or their notes, you can get that information at whitecoatinvestor.com/DLP. Thank you so much, Don, for your time today on the webinar and for what you're doing for White Coat Investors at DLP Capital.
Thank you, Jim. Much appreciated.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.